How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about deposits and basically just staying laser focused on deposits. As they say, keep your eye on the prize. So I want to take a look at an article from Bank Director here. It basically says banks must remain laser focused on deposits. So funding pressures are declining for U.S. banks, but institutions must continue to grow and invest in their deposit franchises. So banks began to fuel funding cost relief in the fourth quarter of 2024 as the Federal Reserve eased rates further, and those declines should continue. However, funding costs are unlikely to drop materially in the near future. So basically, as interest rates have gone, I think a more appropriate way to describe that is interest rates are stuck in neutral. As depositors have woken up to higher rates available in the marketplace, the prospect of significant declines in short-term rates seems unlikely in the near term. Stronger deposit franchises continue to attract higher valuations in the public markets and in the context of acquisitions. Banks would be wise to keep investing in their franchises by improving their technology and treasury management offerings, hiring high deposit focused teams, marketing more products to existing customers, and exploring fintech partnerships that could be easier under the new administration. Many institutions were not able to pursue unique deposit gathering strategies during 2023 and throughout much of 2024 as the liquidity crunch that erupted in the aftermath of regional bank failures pushed banks to bolster their funding bases however they could. For many institutions, that meant going back to the well and marketing good old-fashioned certificates of deposit with elevated rates. That approach shored up liquidity, but has since left institutions with a much greater reliance on CDs for funding. CDs represented 27.7% of community bank deposits at the year-end 2024, up from 25.6% at year-end 2023 and 18.6% at year-end 2022. So, great chart here. Basically looks at, term funding reliance, loans plus HTM securities divided by deposits here. So CDs as total deposits, you can see here the blue line, kind of going down here at 21, but then really picking back up. Federal home loan advances against total liabilities here, not super high, maintaining a decent level. Broker deposits versus total deposits. Again, we saw a little bit of jump here in 23 and 24, but nothing. Again, you're talking about 6, maybe 7% of your deposit base. Nothing really too crazy there. Loans plus HTM security / deposits. You can see here that really dove down in 21, but then has come back off, but then has leveled off here a little bit. But you can see here again, the CD growth going from 21 to 2024 has really jumped up, and that has dramatically increased banks' funding costs. But let's continue here. So many of those products carry one-year terms, meaning that institutions might not feel significant pricing relief until CDs originated before the Fed pivot in September 2024 mature. At year-end 2024, the bulk of CDs were set to mature in the next year, with 34.4% of all CDs maturing or repricing in the next 3 months, while 85.2% of CDs were set to mature in the next 12 months. That's a huge amount of maturities. When those CDs mature, most banks will have to meet market rates to retain the deposits. So while the market has waited for lower rates for some time, CD rates only began to decline late in the third quarter of 2024 and appear to have stabilized more recently. But with that being said, rates did go. A lot of banks probably had CD rates out there, 5%, maybe even a little over 5%. The CD rates have really pulled back now and really have basically settled in probably around 3%, maybe 3.25. You still have a couple of banks out there that have some, 4% offers, but not too many. But the big question for banks is, like you said, they relied more heavily on CDs. They paid up for it, so it cost them a lot more money to acquire those deposits that they needed for funding. Thus, the increased funding costs. But now that they have those deposits, the real challenge is you have to keep those deposits. Like, in other words, if you brought in, say, I don't know, if you're a smaller bank, maybe you brought in 20, 30, 40, 50 million in deposits. But now you have to keep that. You can't just simply allow all those funds to go back. So you're still going to have to pay up for those deposits, but it's going to be slightly less of a sting than it was, a few months ago. So, but I digress. Let's get so. When those CDs mature, most banks will have to meet market rates to retain the deposits. While the market has waited for lower rates for some time, CD rates only began declining in the third quarter of 24 and appear to have stabilized more recently. The number of banks marketing one-year CDs with yields over 4% stood at 906 as of September 6, 2024, down only slightly from the 928 institutions as of June 28, 2024. That number began to fall more notably in the last week of the quarter, however, declining to 788 institutions as of September 27, 2024. Since the end of the third quarter last year, the Fed has cut short-term rates by another 50 basis points, while the number of banks marketing one-year CDs over 4% has dropped dramatically to 392 institutions as of February 21st, 2025. Despite those rate cuts, however, there has been less movement in the number of banks marketing one-year CDs over 3.5%. As of February 21st, 2025, 1,096 institutions were in that group, down from 1,266 as of September 27th and 1,289 as of September 6th, 2024. Community banks could find it challenging to decrease deposit rates quickly in the coming quarters as short-term rates stabilize and customers still find alternatives with attractive yields in the Treasury and money markets. Community banks will have to balance growing deposits and lowering rates on their products and will likely need to remain somewhat competitive with the institutional markets. We think banks should be careful when evaluating the balance and remain mindful that the last few years have served as a reminder that deposits are the true value of a franchise. Executives should incentivize their relationship managers to grow deposits, not just loans, and would be wise to develop niche teams focused on the largest industries in their local market. Bankers should also utilize their own data to market deposits to existing customers who often have relationships with other financial services firms and consistently transfer funds to those institutions. The all-in cost of keeping those funds in-house often will be cheaper than having to spend extra money to acquire new customers. Yes, it's always cheaper to keep the existing customer than it is to acquire a new one. Institutions might also find it easier to pursue fintech partnerships and benefit from the funding that comes with those relationships. FDIC Corp acting chair Travis Hill has suggested, since taking the reins at the agency, that the approach to fintech partnerships will be more transparent under his leadership. Lower rates and the passage of time might offer the opportunity to ease deposit costs, but banks should not lose sight of what drives the value of their franchise. So, couple of interesting things to note here with this. Great article. Again, some of the things that are going to be tough for the industry. So, net interest margin and margin compression is something the industry is always worried about. So, going into the end of last year, it looked like the banking industry was going to have a much tighter margin compression going through at least the beginning of 2025, because the thought process being that your deposit rates would not come down as quickly as the loan rates. Like, loan rates would fall faster than deposit rates as the Fed was lowering rates. But we really have not found that to be the case. I mean, loan rates came down a little bit, but then because you saw the Treasury yields jump up, that pretty much stopped any chance at commercial rates dramatically coming down, or even your residential mortgage rates coming down was quickly stopped. However, banks did bring the funding costs down. They did bring the amount of money that they were paying out on CDs came down a good bit, 100 basis points, 150 basis points, 200 basis points in some instances. So banks did get relief there, and that really helped their margins. The question now is, with interest rates basically stuck where they're at, and with this huge amount of CDs maturing, and banks are still going to have to pay up somewhat to maintain these deposits, we're now beginning to see a little bit more pressure on rates, as we're starting to see some commercial rates back down into the sixes now on residential mortgages and commercial mortgages. That's going to put a little bit more pressure on banks' margins, if you will. So We'll have to see how that continues to play out through the rest of the year. But I think that the advice in this article was spot on. Basically, banks need to keep their focus on the deposit base, grow that deposit base, bring in those extra deposit customers, and think about everything that you possibly can do. Having business development at the bank, having branch managers that are focused on bringing in deposits. Maybe need to beef up your cash management. Look at potential fintech partnerships. What can you do there? So a lot of different options there, a lot of different strategies that banks can employ. But obviously, one of the most critical things, as it is often known and noted, I might add, in the banking industry, that deposits are the lifeblood of every bank. You have to bring in deposits. The deposits are critical. That's why it's called their funding cost. So you got to bring those deposits in to be able to lend the money out and thus grow the bank. So critical thing here. Great article. And again, keep your eyes on the prize, as it were, and that is deposits. So, but with it, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other episodes on the channel. And as always, tomorrow night, BND Strategy Room will be live on YouTube Saturday night at 8 p.m. If you haven't checked that out, that is the main show on the channel. Please be sure to check it out. We go over all the basically big stories of the week, talk about a lot more than I do in these episodes that I put out during the week. So be sure to check out BND Strategy Room live on Saturday night, 8 o'clock on YouTube. But with that, I hope everyone has a wonderful day, and I will see everybody again real soon. Thanks a lot.